Following the Japanese Prime Minister's recent visit to India, headlines began circulating that Tokyo and New Delhi were preparing a direct Yen-Rupee settlement agreement. The online narrative was quick to frame this as a coordinated plan to disconnect from the US dollar. However, Japan remains one of the world's largest holders of US treasuries and relies on the United States for its primary security and trade architecture. This level of institutional dependency makes a deliberate attack on the dollar economically impossible for Tokyo. The volume of trade further complicates the de-dollarization claim. Total bilateral trade between India and Japan currently sits at roughly $27 billion. That is only a fraction of India's trade with South Korea, and it lacks the critical mass needed to shift the global financial balance. This agreement is actually designed to solve a mechanical problem in how these two nations move money. Under the current system, an Indian buyer purchasing Japanese machinery must buy US dollars first, and then convert those dollars into yen. Each step requires a fee, a silent tax draining capital from businesses in both countries during every transaction. Direct settlement acts as a pragmatic financial shield against these fees, protecting the margins of traders who currently lose money to the double conversion trap. This push for local currency is driven by a specific macroeconomic crisis. Both the yen and the rupee are currently experiencing significant weakness against a high-value US dollar. This chart shows the Japanese yen's value over time. It recently hit its weakest level against the dollar in 4 decades. Despite the Japanese government spending billions to defend its currency, the decline has been persistent. When two nations with depreciating currencies are forced to purchase expensive US dollars just to trade with one another, their import costs rise and their current account deficits expand. For Tokyo and New Delhi, bypassing the dollar in mutual trade is a mathematical necessity for economic stability during this period of currency volatility. The proposed localized framework would allow businesses to pay directly in rupees and yen, removing the US dollar from the transaction loop entirely. India has already signed similar local currency settlement pacts with Indonesia and the Maldives in early 2024. In 2023, the Reserve Bank of India and the UAE Central Bank established a formal framework to settle trades in rupees and dirhams. However, even with these official pacts in place, most private corporations continue to conduct their trade in US dollars. The reason for this is currency stability. Historical data shows that the Indian rupee depreciates by an average of roughly 4% every year against the dollar. For a foreign company, holding rupees represents a guaranteed annual loss. The US dollar, by contrast, offers a level of predictability that the rupee has not yet earned on the global stage. This resistance will likely continue until India produces high-demand, world-class goods at a scale that forces the global market to seek out the rupee. Government agreements can create the pathway, but private markets will only leave the dollar when a local currency proves it can hold its value. If private companies are hesitant to use local currencies, why is the Japanese government pushing this deal so aggressively? One major reason involves the defense sector. Japan is currently offering to co-produce Mogami-class stealth frigates with India under the Make in India initiative. Japan's goal is to see these warships used by India, Australia, and Japan. This would allow any vessel in the group to be serviced or repaired at any of their shared naval bases in the Indo-Pacific. A yen-rupee settlement system allows India to pay for these massive defense assets using its own currency, preventing the drain of its US dollar reserves on military procurement. This uses financial policy as a tool to integrate India more deeply into a regional security architecture. Tokyo's strategy is also tied to a pledge to invest 10 trillion yen, roughly 60,000 crore rupees, into the Indian economy by 2030. For Japan, converting its currently weak yen into expensive dollars just to transfer that capital into India would be a massive financial penalty. This direct framework creates a bypass, allowing Japanese firms to move capital directly into Indian infrastructure and technology using local currency. Japan is betting that by investing their weak currency now, they secure a foothold, collecting returns when their currency eventually recovers. The yen-rupee settlement reflects Japan's focus on securing its long-term economic interests while providing India a path to increase the global utility of its currency.